The banks are about to be crushed. In fact, it's going to be worse than what we had in March 2023. The losses are piling up right now at this time. Number one, we are going to look at what is actually occurring, the problem. Why is it happening? That's number two. And then what you as an individual can do about it and what you need to avoid. In this video, we are going to look at all of these aspects and I'll make it real simple, real easy. Sound good? Let's begin. The first thing we need to look at is what's happening at the banks. What's going on right here? Well, of course, you've probably seen it, but there's a lot of red going on in the markets over the last couple weeks. At the same time, we've seen the bond market going wild. In fact, bonds are getting crushed. I'm going to explain what that means here in a second. For anyone with debt coming due, this is a rate shock. Any real estate person who has a loan coming due, any business whose floating loan is due, this is tough. The spike in yields also adds pressure to the regional banks holding bonds that have fallen in value. One of the key factors in the failure of SVB and First Republic. Analysts don't expect more banks to collapse. The industry has been seeking to offload assets and already pulled back on lending. Oh, yes, that's right. In fact, though, when you look at the actual data, the most loans are being given out, especially in commercial real estate, which you know, and I know, that commercial real estate is the weakest link right now. And yet, with commercial real estate, this is overwhelmingly done with regional banks. So they've got losses piling up left, right, and center. So watch this. We are now 100 basis points higher in yield than in March. So if the banks haven't fixed their issues since then, the problem is only worse because rates are only higher. So when you have to understand this overall, the problem is more debt, higher rates, and essentially, you know it, the problem never being resolved in the first place. And now here we are several months later with the problem getting worse. They've poured gasoline on this fire right now, and we've got to watch out. Let's break it down further. The collapse in Treasury bonds now ranks among the worst market crashes in history. Many people didn't realize this, but we're right in the middle of it. I know everybody likes to focus on the stock market, but we got to listen to the bond market as well. It's a little bit more complicated in some ways, but just take the basics. That's what we do here at this channel. We don't get into the nitty-gritty of it all. All right. Since March of 2020, Treasury bonds with maturities of 10 years or more have plummeted 46%. That's just under the losses seen in the stock market when the dot-com bubble burst. The bond rout is worse than the one seen in 1981 when the 10-year yield neared 16%. So we know that there is chaos in the bond market going on. And so that is a problem. Who is it a problem for? The number one factor being the banks. The Q3 sell-off in rates could push banks' unrealized losses back to their highs. And this is absolutely the case. As I said just a moment ago, you've got rates that are higher now than they were before. Losses that could exceed where we were at that point where you had multiple bank failures. This is about making you understand the system, this current system from the top down. The Federal Reserve increased interest rates in response to inflation. They brought that up. As a result, the bond market started acting real wacky, something they haven't experienced in a very long time. Why? Because bonds, interest rates were very different in 1980, right? But for 40 years, it was going down and down and down and down and down and down. And everybody said that it would continue. Yes, it fluctuates, but they said ultimately it's just going to keep going down and down and down. And so you were getting a lot of these bonds. Remember, if you were on this channel, negative yielding bonds. What is a negative yielding bond? That sounds weird. A negative yielding bond is like, let's say you're going to buy a 10-year bond. Now you would think, I don't know, what kind of return would I get on that? Maybe 2%, maybe I get 5%. How about negative return, a negative return, like minus 1%, let's say. Well, why would you do that? Well, that's what was happening. All of these big countries had negative yielding bonds. It's crazy. You put your money in, you guaranteed to get less back at the end of it. What kind of investment is that? Like, it's like getting punched in the face. I mean, why would somebody do this? Well, that's because it was so-called secure. Well, I mean, I'd rather lose 1% than have the potential to lose 10%, 20%, 30%. Who knows? Uncertainty, right? So say, hey, I'll lose 1%. That's a wacky world. Anyway, so we had this falling down, falling down. Now it came back up despite what almost everybody was saying no, it wouldn't. But of course, if you understand the data and you were here on this channel, you knew what would happen. And so here we are today with these banks facing reckoning. And so we have to look further into the details. Always, generally, what we're seeing anyway, is that the speculators on the credit default swaps, this is essentially a bet on failure or seen as insurance against a failure. They're buying it up like crazy on Goldman Sachs, Morgan Stanley, and so on. So all the big banks. So the expectation here is that they're going to have some failures. And the last time we saw this, right before SVB failed. And so they can be a little like they can jump to conclusions, let's say, but at the same time, they were often just, before the event happens, that's when you want to get in on that. 10-year Treasury yields rose more than half a percentage point in the past month to surpass 4.7%. And by the way, this 10-year is directly correlated to mortgage rates. So when that moves up, so do mortgage rates. And guess what's nearing 8% right now? Mortgage rates, 8%. So of course people are getting stretched, right? That heightens the danger in the near term of a financial blow-up akin to the regional bank breakdown in March. Longer run, it threatens to undercut the economy by markedly raising booming borrowing costs for consumers and companies. So there you go. All right. That's a big one. I'm trying to tell you it over and over and over again. I'm not trying to, just tell you based on a theory or anything. I'm showing you the quotes. I'm showing you the charts. All this information is public and it's all there. I could, give you so much hyperbole it'll make you sick, or you can just take the data. And that's what I like to do here at this channel. If you do appreciate that, hit that thumbs up button because you're letting other people know that, yeah, I want this guy to be shown in the algorithms. So I do appreciate that. Thank you. Fed's daily says a rise in bond yields may mean the Fed can stay on hold because essentially if the yields are going to rise, it's going to slow the economy down and they will not have to increase the Fed funds rate more. We'll see what happens. They're already at a rate everybody said they would never get to. All right, we know that. And so what I want to tell you right now is that if you haven't already, you got to join the giveaway. I got a giveaway going on right now. By the time you're watching this video, it should still be on. So the giveaway is for one free entrance, one free ticket into the membership that we have, the mentorship. And so you can get one free call in there, small group. Go to the link in the description, join the Discord, you go in there and you will see that for yourself under the announcements section. So you go to the announcements, get your free call. I would love to see you in the mentorship program. All right, now looking at this, here we go. And by the way, the giveaways, that's going to be once a month for that. And I'm going to extend the giveaways. I'm going to do more and more and more giveaways, but you got to join the Discord to get there. So join the Discord. All right, look at the financial conditions. They have been tightening since July, up and up and up. And this makes it, this is, it's not just about the Fed funds rate. It's many factors. And ultimately, financial conditions start to tighten. And of course, what have we seen overall? The stock market has been tightening as well, if you want to look at it like that. The debt circumstance, just something real quick I wanted to touch on. This is, when you look at Goldman Sachs, what they had to say, but using data from the CBO and others, we are raising our interest cost projections on the back of higher rates. So expecting that, of course, it's going to be a bigger burden on businesses, on the country as a whole. The public does not see the deficit as a major concern right now, but interest costs and debt levels should soon peak for the first time together. So weird things are happening right now. Weird things. It's not 1970 anymore, guys. We're not in that time frame. Then we have this. We estimate interest costs as a share of GDP will reach a new peak in 2025. And this is all expectations and projections that we really don't know. But what I do know is that you have to take action today based on this. What can you do? Well, let's talk about that right here and now. Banks or bank ETFs like KBE, this is just one example. Don't take my, these tickers as advice or anything. Or KRE, and that's the regional banks. Oh my goodness. They could be punished. Absolutely punished, especially the regional banks. So if the banks start to deal with more pressure, these are going to get crushed. The banks themselves, but also the ETFs associated in regional banks being the weakest one. Next, your money could be held up if your bank has liquidity issues. Doesn't matter about how big your bank is. Doesn't matter if it's a regional bank or nothing. It could be held up. I'm not saying that they're going to necessarily do a bank bail-in. I'm not. What I'm telling you is that they could say, okay, well, we just can't get to your money today and we'll get it to you like 3 days from now or next week or who knows. So knowing that information, be prepared accordingly. You could be locked out for a period of time. Investing in real assets has the best long-term track record. And that is an absolute matter of fact. Something that's tangible, something that's real, something that is physical is always going to maintain value, not just over a cycle. It's going to maintain value potentially for decades and generations. And that's where you want to have a lot of your money. So you want an investment vehicle that brings money in consistently. And when it does, it's paying your bills as well as it is putting a percentage of that into something that just lasts for decades and generations. Okay. So for you, the individual, you need to get your stuff sorted out. You need to figure this out. And the best place to start is a free place that I built for you. Over 500 people have joined in, and that is Compass. You can get Compass for free. No email, no paywall, no nothing. I just want to see you there in Compass for free. You go through, click on it, and it's just themoneygps.com. Super easy, themoneygps.com. Click on that button that says Compass and you're in. Get your finances in order. Your financial journey starts here. And then last but not least, the comment of the day. Thank you. And by the way, thank you for your comment. Thank you, Mr. Soft Landing, for another informative, helpful video. These bankruptcies are going to hit like a tidal wave next year. It is absolutely possible that we will encounter more difficulties if you've got rates rising, if you've got these problems simply just going through the motions right now for a lot of these businesses. And I don't know how they're going to withstand these rates going any higher. I mean, they need them to reverse, and we're just not in that time frame now. They need a catalyst. They need a crisis to happen, and then things can reverse. Until then, let's play ball. I hope you appreciate this video. I'll see you on the next one. Take care.